They see it. A lot of business people are living in the real world in real time. They know what's happening now, and the stock market tends to figure it out later. But as far as banking and credit is concerned, what happens is if you're a business person and you see business heading down, fewer customers, whatever, you go out and borrow all you can. You're like, hey, there's a really bad recession coming. If I got lines of credit, I'm going to use them up now. I don't want my bank changing the terms. I don't want material adverse average change clauses kicking in. Instead, I'm going to borrow everything I can. And that creates a demand for funds and interest rates go up. And then the recession hits and the bankers go, what's going on? Credit losses start going up. And then they just turn off the spigots and they raise standards. They stop doing loans. And then interest rates will start to come down. But interest rates peak after the recession has already begun. So stock market's telling us Goldilocks, bond market's telling us, here comes, Hurricane Mitch or whatever. And then there's what I call the reality. What I see is a kind of a hybrid. The Fed's doing what they're doing, right or wrong. Okay, they're doing what they're doing. The market has their own interpretation. I agree with the market, certainly the bond market, that the Fed has probably over-tightened. They're going to keep going for the reasons I explained. That means they're going to make it worse. They're going to make the recession even worse. And we've seen this movie before. This is exactly what happened in 2018. I mean, I don't know. Attention spans seem to be short these days, but it wasn't that long ago. Go back and look at a chart, any stock index chart from October 1st, 2018 to December 24th, 2018. The stock market dropped 20%. I mean, it's like 19.9 or something on the Dow, so maybe not technically a bear market, but yeah, what's the difference? It dropped 20%, culminating in the Christmas Eve massacre, December 24th, 2018, when it dropped, I think NASDAQ dropped like 3% in one day. Now, here's the point. The Fed was tightening into that collapse. The Fed tightened on December 16th, 2018, only like 8 days before the Christmas Eve massacre. And after most of the 20% collapse had already happened, they tightened one last time. So what it shows you is that when the Fed's on a mission, they actually don't care about the stock market, this whole, Bernanke put and Greenspan put and all that. That's not how it works. They don't care that much about the stock market level. Here's what they do care about. They care about disorderly markets. And that's the key word. It's not if stocks are going down, but it's, kind of a little, 0.5% a day, 1% a day, trending down, lower highs, lower lows, trending down. The Fed doesn't care about that. They're not going to bail out the stock market. They do care if it's disorderly. When was it disorderly? Well, March 2020, at the worst part of the pandemic, it dropped like 30% in like 2 or 3 weeks. The fall of 2008, I mean, it was like somebody opened a trap door. The Fed does care about that because that kind of disorderly behavior can feed on itself and end up in a 1929 type scenario. So the Fed will get the memo, as I put it, stop raising rates and begin cuts when the markets are disorderly, but not just because they're going down.
Jim Rickards said that the Federal Reserve will only care enough if it's a disorderly collapse, meaning if the markets, either stocks or bonds, are going down like 30% in just 2 weeks. If it's just a little plunge in a day like a 5% drop in Amazon stocks, then the Fed won't care about it. But what the Fed and everybody is missing is the state of the economy itself. The unemployment rate is at its worst now, and massive layoffs in the tech industry are in the news everywhere. Because of what, you might ask? Yes, you are correct, it's because of the high interest rates. The companies need to pay more for the interest on their debt, so they have to reduce their headcount. At the same time, their revenue decreased because consumers unsubscribed from their services because of the rising prices everywhere, whether it's groceries, gas, or even food. So yeah, everything will go south, I guess.
Now, here's what the Fed is missing, or maybe everybody's missing. When you hear these layoff announcements, people are like, well, if they're laying off, why isn't the unemployment rate going up? Unemployment lags the business cycle. Unemployment is a lagging indicator. When you're an employer, entrepreneur, and you're in any kind of distress, not as many customers walking in the door, you'll do everything you can to avoid laying people off. You'll, be late on the rent. You'll turn down the lights, find a cheaper laundry, whatever it takes. And then by the time you get around to firing people, you run out of options. Like, I've done everything I can. Now my business is in jeopardy. I have to fire some people. So that, and then combine that with what I just said about severance and rolling terminations, et cetera. It's a lagging indicator. We know enough right now to know that number's going up this spring. But that's not inconsistent with the fact that we're already in a recession. It's exactly what you would expect, that unemployment's a lagging indicator. Now, having said that, what else is the Fed missing? Well, wages are up 5% on an annualized basis, 5.2% on an annualized basis. I'm like, yeah, and inflation's 7% or 6%. So your real wage just went down 1 or 2 points. Because when the Bureau of Labor Statistics reports those wage numbers, those are nominal numbers. I'm not saying they're fake, but you have to know that they're nominal, and you have to subtract inflation to find out what's happening to real wages. And the answer is real wages have been going down for a couple of years because they runs around 5% annualized, give or take. Sounds like a 5% raise. What do you want? Well, yeah, but with 8-9% inflation, or even 6% inflation, your real wage is going down. So that's not a robust number at all. The Fed, by the way, the Fed wants to make it worse. The Fed agrees that those wage gains are too high. But my point is, in real terms, they're actually going down, but the Fed wants them to go down more. That would be one way to put it. If you get inflation down and wages are constant, then the real wage goes up relative to where it was before. But if you're unemployed, you have no wage. So that's another issue. Now, what the Fed is missing, and it's a long list, but there's something called the labor force participation rate. Now, the labor force participation rate, you just take the number of people working divided by the total working age population. It's all you do. It's not sophisticated. And that number today is around 61%, 61.2, give or take, percent. But as recently as 2000, that number was over 70%. And has come down ever since, and it dropped like a stone during 2020, during the pandemic lockdown. Came back a little bit, but not much. The reason it got, first of all, it's never 100%. It shouldn't be. There are legitimate reasons to be working age population not working. You're a homemaker. You're a student. There's a bunch of perfectly good reasons. So it's never 100%, not even close. But 70 is pretty high and 60 is pretty low. And the trend has been down. So that leaves, relative to kind of a normalized number, that leaves about 8 to 10 million people between the ages of 25 and 54 who are not in the workforce. There's a big untapped labor pool. But if you took that group and threw it into the unemployment numbers, the way the Bureau of Labor Statistics calculates it, unemployment would be about 9%. And that's a depression level of unemployment.
Why are those residential real estate prices going up? And the same thing's happening in the United States. The answer is that there is an exodus, and I don't think that's too strong a word, out of the cities. People are put off by, cities have always been a trade-off. Cities are, okay, you have a lot of noise and some dirt and some hassles and maybe a slightly higher crime rate. But on the other hand, you have art and culture and museums and shows and restaurants and bars. And so you make the trade-off. You say, I'll accept these annoyances in exchange for all this, culture and buzz. And cities attract, the brightest people. So whether it's, bankers or lawyers or doctors or artists, playwrights, actors, whatever, it's just, there's a lot of buzz. That's why people go to cities. With these lockdowns, we've amplified all the negatives and taken away all the positives. We've shut the museums, the restaurants, the bars, the plays, the office buildings, things that attracted people. But meanwhile, again, probably not as bad in Australia as it is here, but crime is on the rise. Murder rate in New York has doubled. Suicide rates across the country have tripled. And that's New York. The suicide rate's national. There are all these dysfunctions, and a lot of them, and of course, when you have highly concentrated populations, which you do in cities, a lot of that's worse. So what people are doing, I say people, it's the people who can afford it. They're getting out of the cities and they're going to nearby suburbs or even further out, what we call exurbs, which are, the next ring beyond the suburbs. And so there is that demand for housing. I'd be willing to bet money that the place you're describing is a pretty attractive neighborhood. So they're booming, and the same thing's true in the United States. But what's the other side of that? We're depopulating our cities. Cities are the greatest wealth generating phenomena in the history of civilization. That's what civilization means. It means cities. And so if we're depopulating and draining our wealth creating engine, what does that do to the economy long run? So as an individual choice, it makes sense and I understand it. But the macro effect is we're depopulating these wealth generating places. I mean, just take any downtown area. It could be Melbourne or Adelaide or Sydney or New York for that matter. If there's an attractive downtown office building, let's say you're a large company, insurance company, whatever, and you used to have 10 floors as your corporate headquarters. Well, now everyone's been working from home for almost a year. That's nothing that anyone would have recommended, a year ago. But we were forced to do it, and guess what? It works. Employers and employees are finding that, hey, it works. You can communicate and get stuff done, and maybe there's some attractions to it. So this work from home thing is here to stay. What companies will do, they'll say, well, instead of 10 floors, I only need 2 floors, and I'll have attractive offices, but you'll reserve them. You'll call up and say, hey, I need an office 2 days next week to meet some clients. Done. They'll build locker rooms. They won't be like high school locker rooms. They'll be very attractive. You'll keep your laptop and your sweater and your scarf or whatever in your locker. You'll show up, take your stuff out of your locker. Some receptionist will tell you which office is yours for those 2 days. Set yourself up, meet your clients, go home and work from home. What does that mean? If you cut commercial real estate capacity or utilization by 80%, we'll start with the cleaning crew and the reception, but what about the food trucks, the restaurants, the shopping, the public transportation, drinks after work, on and on and on, all the things that are ancillary to that downtown office location. You cut that by 50 to 80%. What is that doing to your economy? So these are examples. By the way, this will take a year to play out. This is not an overnight thing. So the tenants are not paying rent. If they are, they've called up and negotiated a 50% increase. I have some involvement in commercial real estate, and I see this in real time. So rents are down by perhaps half or all the way to zero if they're not paying. And everyone says, well, landlords are rich. No, they're not. The landlords take the rents, but they have mortgages. So if the tenants aren't paying the landlords can't pay the mortgagee, and that falls on the banks, right? Except the banks are clever. They've securitized it and sold it probably to you and me, right? We have our 401ks like a superannuation fund, but you look in the fund and do you have some, commercial real estate REIT or something that Morgan Stanley sold you? Well, maybe you do. And what's inside? No one knows, but take a look. But that ripple effect I just described can take a year to play out. So we haven't seen the end of this. So the bottom line on all this is that interest rates are going up in anticipation of inflation based on handouts. The reality is the handouts are not being spent, they're being saved, which does nothing for inflation. And it's also not sustainable, which is what are you going to do? Hand out a $2 trillion deficit spending package every 6 months? Because that's kind of what we've been doing since last summer. And they keep saying, well, this is the last one. It'll be sustainable. It's not sustainable. It's a handout and people need the money. But if they put it in the bank, which they're doing, this is a classic liquidity trap. So what's going to happen? Yeah. But meanwhile, the interest rates are going up, perhaps for the wrong reason, but they're going up. That's going to slow the economy further. We're already seeing mortgage applications dry up. We're seeing the housing bubble, not bubble, but pretty steep increase in residential housing starting to level up. So by, hard to say, but I would say by March or April, this whole thing is going to go in reverse. Everything we just talked about is going to go in reverse. The economy is not going to have the traction. Unemployment is going to remain high. Velocity is going to continue to drop. There's not going to be any inflation. Those interest rates are headwind. They're going to drop and the price of gold is going to shoot up. So my advice to the potential gold investors is it's on sale. Go get some right now. It's always better to buy low and sell high. And but I would expect the price to be much higher by mid-year.
I know that you've said this before, or I'm pretty sure you've said this before, that to stimulate an economy, you need to reduce interest rates by somewhere around 3-4% to have an effect. When interest rates are currently at zero, how can you do that? Where do you go from zero?
Well, a couple of things. The short answer is you can't. You in theory, you can go to negative rates, but negative rates don't work. We have experience from the ECB, Sweden, Japan, Switzerland, elsewhere, that negative rates don't work. They're negative rates, but they don't. It's not more of the same. Cutting rates from 3% to zero has a beneficial effect, but cutting them from 0 to -1. Now you're through the looking glass. You don't get any more pop. You don't get any more bang for the buck. And there are reasons for that, which are as a central bank, what signal are you sending? Well, see, the idea of negative rates is you're going to spend the money, because if I'm going to take it away, you put money in the bank Even at zero, you put money in the bank, you go away for a year, come back, the same amount of money should be there. That's the zero interest rate. But a negative interest rate, negative 1%, you put $100,000 in the bank, you go away for a year, you come back, you only have $99,000 because I took $1,000, that's 1% negative interest. So the idea is, if I'm going to take your money, you're going to spend it fast because you don't want me to take your money. And that's going to have the stimulative effect that we talked about. That's not actually what happens. What happens, two things. Number one, people have lifetime goals. Their retirement, their healthcare, their parents' healthcare, their children's education, buying a house. There's some large lifetime goal you have, and that's why you save money in the first place. If I'm taking your money away, you're going to save more, not less. You still want to achieve that goal. I've made it more difficult, but you're actually going to save more. They want you to spend it, but now you're saving more. And the second thing is, what signal is a central bank sending when they have negative interest rates? They're saying that they're worried about deflation, not inflation, but deflation.
Yeah.
So if they're telling me, if central bank is telling me that deflation is a problem, I'm going to wait. And why should I buy anything right now? Wait till the price drops. And by the way, a negative interest rate, negative 1%, my example, is a nominal phenomena. But in real terms, if you have deflation, my money is worth more. So even though my dollar amount may be less, my purchasing power went up because prices went down. And so that's why negative interest rates don't work, because A, you're sending a deflation signal, so people defer spending, and B, they have lifetime goals, so they actually save more. So negative rates don't work. So you're right, you're stuck at zero, there you are. Pardon me, you can do QE, you can do quantitative easing. And usually what happens is they hand the ball over, it's a rugby match or whatever, but they hand the ball from monetary policy, which is now impotent, to fiscal policy, which is deficit spending. But there you have other kinds of headwinds having to do with very high debt levels. More to the point, in terms of what a central bank can actually do, they can't stimulate. They can print money, and governments can spend money and incur deficit spending. But again, none of it does any good if people don't actually spend it, and that's a psychological phenomenon. And the Fed or the Reserve Bank of Australia or any central bank can print money, no doubt about it, but they can't change people's psychology. We had an external shock, an exogenous shock in the form of the pandemic that caused people to stop spending, save more, or they were unemployed. Or if you're the unemployed individual, you're not taking your friends out for dinner these days. You're putting money in the bank, and even if you still have your job, you're going to save money because you're worried you might be next. You might be the next one to get laid off, or your company might shut down next week or next month. And so you're going to save more. It's what economists call precautionary savings, or, in plain English, saving for a rainy day. And that's what's going on. It's going on all over the world.
The U.S. is heading into recession, and we may be in a recession. Everyone's like, wait a second. Yesterday, GDP was up 5%. And that was the number it was the first government estimate for the third quarter of 2023. It was up 5%, but it was very heavy on consumption and very heavy on inventory. When wholesalers and distributors build up inventory, that counts as GDP. Well, it's fine to build up inventory if people are buying the stuff, but if they don't buy the stuff and you're up to the rafters in inventory, you got to start writing it down. This is where you see, you go to the Gap and you get like 10 shirts and 5 pairs of jeans for $30. I mean, the inventory situation comes down to the consumer. Are people buying stuff? It looks like the consumer hit the brakes in August. Now, the second quarter is July, August, September. Sometime around mid to late August, after 2 pretty strong months, and they were strong, the consumers just hit the brakes. Now, they've done enough to make the third quarter strong, but going into the fourth quarter, they may just, not show up for the game. A couple of reasons for that. Number one is, during the pandemic, you go back to 2020, 2021, what was going on? Well, starting with Trump in, I think, June 2020, he gave everybody a $1,400 check. If you got a heartbeat, you got a check. And then Trump did it again in December 2020, just before he left office. It was another $600 check. Biden comes in and says, well, I can top that. And Biden does in February 2021, right after he was sworn in. Here comes another $1,600 check. And then when people got those checks, they saved a lot of it. So what happened in 2023? People drew down their savings. The savings rate got really low. Like, they spent the savings they had. They didn't make new savings. And then they turned to the credit cards. and ran up their credit card balances. Well, that feels good for a while, but then if you're paying the minimum and rolling over the balance and you're at your limit, your credit limit's used up, and the interest rates are 20%, some of them are 28%, you're going to double that balance in 3 years. So if you're like, I'll just pay the minimum this month and I'll figure it out, your balance is going up because the interest is compounding faster than you're paying it down at 25, 20, 25%. So people are tapped out on their credit cards. They've used up their savings. They're getting into a deeper hole because the interest is compounding faster than they can pay off the credit cards. And they're just backing away. And it's showing up in things like gasoline consumption. It's way down. The demand for gasoline is what economists call inelastic, meaning you just have to buy it no matter what the price is. You got to take the kids to school or get to work or go shop, whatever it is. You're just going to buy the gasoline, even if you don't like the price. By the way, lately prices have been coming down a little bit, which is another, that sounds good, but it's actually a bad sign because it's disinflationary, which kind of leans in the direction of a recession. But for gasoline consumption to drop, forgetting about the price, that means people are not driving. They're not going on vacation. They're not doing road trips. They're not driving any more than they have to. There are a lot of other signs. We don't have time to get into all the technicals with negative swap spreads and inverted yield curves and all the rest. But it does look like the consumer slammed on the brakes around late August, early September. The fourth quarter could be a disaster. The stock market's starting to wake up to that fact. So I would say it's a pretty simple recommendation, Matt. Reduce your exposure to stocks overall. Increase your exposure to cash. It'll give you, you won't lose money on cash, assuming that inflation is not bad, and it'll give you a lot of optionality. You can go, if things get really, really, really bad, if you have cash, you can go shopping and find some bargains. But if you're in stocks and they go bad, you're just going to lose that money and never see it again. But if you do have stocks or some stocks, I would look at energy, defense, not for good reasons. There's enough wars going on, but defense will do well, and mining because gold and silver prices and strategic minerals will do well. So defense, mining, and energy are the sectors I'd be in. I'd lighten up on tech, get out of everything else, go to cash. Treasury notes look attractive here because interest rates are going to start to come down. I know they've been going up. I get it. But it looks like they peaked and have turned around. So treasury notes, a good 2-year note, a 5-year note will perform very well. And they're very safe, obviously. And just take it from there. But you've got to be tuned into the geopolitics to understand the stock market. You can treat them as separate subjects, but if the world's falling apart, so that's not good for stocks. Right. So when we say bond markets, Matt, we have to be careful which bond market. I'm talking about the U.S. Treasury bond market. The short-term treasuries, 4-month bills, 6-month bills, up to 1 year. The funny thing now is that the highest yields in the U.S. Treasury market are in like a 6-month bill. Like, wait a second, shouldn't I get more if I buy a 30-year bond, or shouldn't I get more if I buy a 10-year note? It's a longer maturity, more stuff can happen, inflation, bank freezes. All those things can happen. I want a higher interest rate for my longer term security. That's usually the way the yield curve looks. It's upward sloping. The longer the maturity, the higher the rate. That's not true today. The highest maturities are right around 6-month bills, 1-year bills, going out to 2-year notes. When you get to the 10-year note, you actually get a lower interest rate, lower what's called yield to maturity than you do on a 2-year note. The interesting thing about 2 years is you get a high rate, but it's less volatile than a 10-year note. It's more liquid. And 10-year notes are pretty liquid, but 2-year notes are very liquid. So you can actually have the best of both worlds. You can have a shorter maturity, which means less risk in some ways, and a higher interest rate. So it's like I said, the best of both worlds. But the highest interest rate is actually from 6 months to 1 year. So those are very, very safe securities, and they're paying like 5.25%, not quite 5.5%, but between 5.25% and 5.5% for 6 months, for a 6-month treasury bill. Why wouldn't you just buy one of those? I mean, it's more than what you get in the bank. Now, the answer is, well, yeah, Jim, that sounds good. But if interest rates go up even more, you're going to lose money on your capital. The value of the note or bond will go down if interest rates go up. That's bond math 101. Rates go up prices go down. The opposite is true. Rates go down, prices go up. So you can make or lose money, but that inverse relationship kind of throws a lot of people, but that's just how it works. So yeah, buying a 2-year note that yields about 5.1%, very liquid, very safe, good return, more than your bank will pay you, more than most stocks will pay you. Why wouldn't you do that? Well, the answer is, if you think the 2-year note is going to go to 6%, you might not like it, because you're going to, if you hold it for 2 years, you'll get your money back. But if you want to sell in the meantime, you're going to have a capital loss on the note itself. So therefore, the next level of analysis is, well, what's going to happen to interest rates? Everybody wants to know that. In my view, they've peaked. They're going to come down. And if you like that action, you might prefer the 10-year note, because a longer maturity has a higher, not to get too technical, it's called DV01, dollar value 1 basis point. And what it means is that, so interest rates come down a certain amount, 25 basis points, 50 basis points, or whatever. And I said bond prices go up, which they do, but how much do they go up? Well, the answer is, the longer the maturity, the more they go up. They're more volatile. And so 2-year notes are a really attractive piece of paper, very safe. You get your money back, liquid, you can get out of it, etc. The only reason not to buy would be if you thought rates are going to go up. I think they're coming down from here on out. But if you accept that view, then the 10-year note is going to have the biggest capital gains. Now, again, it's riskier. When I say risky, I'm talking about market risk. I'm not talking about credit risk. You are going to get your money back, but from a market risk point of view, if you had to sell it, a year from now or 6 months from now, for that matter, if rates go up, you're going to lose a little money on the value of the note itself. But if rates come down, not only do you get the 5% interest rate, which is sweet, but you're going to have a capital gain on the note, because that's what happens when rates come down. So the big question is, have rates peaked? And I would say they have. And I base that on what I said earlier about the economy. If we're going into a recession, we're going into a slowdown, we're looking at all kinds of geopolitical risk, stocks are coming down, then interest rates are going to come down too. The people ask me, are we going to have a recession? And my answer is, we might be in a recession right now and not even know it. We could be facing a global recession, including China, but just focusing on the U.S. because that's the Fed's sort of territory. So Powell saying, the economy is great is nonsense. What he said, by the end of the year, we could be looking at 4.2% unemployment, 3.5 to 4% interest rates, and, kind of 2.7% inflation. And you're like, wait a second, inflation is 8.6 today. How do you get to 2.7, number one, and then what about rising unemployment and higher interest rates? How do you reconcile those things? He said all three of those things, but what state of the world could make those things come true? There's only one, which is a recession. A recession would do it. A recession will raise unemployment, higher interest rates will cause the recession, and the recession will cause inflation to go down. So in effect, Powell was saying we're going to have a recession. Inflation, prices go up, so we understand that, or maybe put differently, the value of your money goes down. You don't get as much for your money, same thing. But inflation, broadly speaking, has two causes. One is called, not to get too technical, but it's called cost push. This comes from the supply side. So there's a shortage of oil, and we got a financial and economic war going on between Russia and the United States. U.S. really started it, but U.S., EU, Canada, Australia, Japan versus Russia. That's obviously disrupting supply chain, cutting down energy supply, causing the price of oil to go up, et cetera. So that's coming from the supply side. And you're exactly right. The Fed can't drill for oil. The Fed can't plant wheat. The Fed can't make semiconductors. So they can't do anything about this. And the supply chains are breaking down. They were breaking down before the war in Ukraine, but Ukraine has made it worse. The other source of inflation is called demand pull. And this is when individuals, you, me, and all of our viewers and, everyday Canadians and Americans worry about inflation. We say, well, I'm just thinking about buying a refrigerator. Better buy it now before the price goes up, or the car, house, or whatever it might be. They're different, but they affect each other. When the cost push inflation from the supply side has enough effect, there's a tipping point or critical threshold in psychology. We say, maybe it is out of control. I better go buy some stuff. Then the velocity of money goes up and then you get inflation. So the Fed can't do anything about cost push. They can't do anything about the price of oil. And you're right about that. But they're looking at the demand side, saying, hey, if this supply thing goes on long enough, eventually the psychology will change and we'll get demand pull and behavioral. And that is really hard to change. So what they're trying to do, they know they can't change the supply side, but they're trying to squash the demand side before it gets out of control. Now, the question, of course, is can they do it? The answer is they can do it, but at what cost? So a general rule of thumb, this is really simple. You have to get, forget about nominal interest rates. Nominal interest rates are the rates you see on your screen, you hear about in the headlines and all that. Real interest rates are nominal interest rates minus inflation. Take the inflation out and see what's left. Well, right now, real interest rates are about 2%, actually 1.75% under the Fed's policy rate. Inflation's 8.6%. So, just round numbers, 1.5 minus 8.5, that makes the inflation rate -7. That's nowhere near. It's got to be +2. Real rates have to be +2 to squash inflation. Right now, they're -7. So that implies that the Fed has to raise interest rates to 10.5% to get to +2 real interest rates. That's never going to happen. They're never going to get there. They will destroy the economy long before they get there. So the Fed has no hope of squashing inflation from the demand side, as you described, by raising rates, unless inflation comes down for other reasons. So what they're going to do, they're going to keep raising rates, 2, 2.5, 3, 3.5, 4, hope that inflation comes down from 8 to maybe 3, although I think that's a stretch. You could get into positive real rate territory, but they're really far away from it. So I think, by the way, I described what they're trying to do. I should make it clear they're going to fail. The only way inflation comes down, the way we're talking about, is if they trash the economy, a severe recession. If that happens, yeah, you say, well, people still need to put gas in their cars. Well, you're right, but not if they're unemployed, because they're not going to work. There's a lot here that's just for show. It sounds good on TV, but there's a lot less here than meets the eye. But the point is, this is not over anytime soon. Even if it were, when you break supply chains, you can't just put them back together. It's like breaking a vase in 1,000 pieces. And you got to go buy a new vase. It's going to take years to undo this damage. So I spoke to the individual who was probably the single individual most responsible for building the modern supply chain. It was 30 years from 1989 to 2019. It was head of one of the largest companies in the world, and this is what they did, among other things. And he said, Jim, you have to understand, it took us 30 years to build it. It took us 3 years to blow it up. It's not going to come back in a year. This is going to take 5, 10, 15 years to build a new one. So it's what I call supply chain 2.0. Well, buying a refrigerator is a good idea. Buying a freezer might be a better idea. We're looking for food shortages by the fall. Now, when I say food shortages, in Africa and Middle East, this will mean mass starvation. You may see the greatest humanitarian crisis in history, because they literally can't get the food. Everyone's like, well, gee, you can't get Ukrainian wheat. What's the big deal? Buy it from somewhere else. There is nowhere else. Canada and the United States grow an enormous amount of wheat, but we use most of it internally. And we feed, because it's not for humans, by the way, we feed our animals. This is how you feed cows, pigs. This is how you get beef and pork. This is an example of the supply chain, how it filters all the way through. So you would expect higher prices to persist. You would expect food shortages. Buying a freezer is not a bad idea. The future supply chain is going to be it goes by different names. Janet Yellen calls it friendshoring. Macron calls it constellation. I call it a college of nations. But basically, we'll have supply chains and trade, but it'll be sort of members only. So U.S., Canada, Australia, Europe, others, Japan, will be invited to join, but not China. Russia is going to be in the waiting room for a while. We should be better allies of Russia, but the Democrats in the United States have pretty much made that impossible, at least for the short run. And then there'll be other countries that are kind of neutral in that scheme, Brazil, India, and others. But the point is, you'll still have trade and you'll have supply chains, but it'll be kind of friendly countries, members only, and exclude China. So that decoupling is going to go ahead. The Chinese seem to be not only fine with it, but they're actually leading the way. Semiconductor manufacturing is moving back to the United States. The 20 billion of new semiconductor plants from Intel. And why is Taiwan Semiconductor spending over $5 billion to build new semiconductor fabrication plants in the United States. Well, obviously, because they're worried about China. We're reshuffling the deck, but none of this stuff is easy. I mean, semiconductor plants take 5 years to build. A new refinery, forget it. That's like 7 to 10 years. We haven't had one in the United States since 1977. So it's going to take a while to do all this. Well, we can do it. So if I said we're definitely going to have inflation, you would know what to do. You'd buy gold, hard assets, land, silver, treasury notes, government bonds, etc. If I said we're definitely going to have deflation, you would also know what to do. You would reduce leverage. You would have more cash, and there are other assets you could go into. The problem is we could have both. There's no question we have inflation right now. It's front and center. But if the Fed squashes it and causes a recession or worse, you could flip to deflation very quickly. So this is going to sound like an obvious statement. What you want is diversification. Sounds obvious, but most people don't know what diversification is. I see people, I've got 50 stocks in 10 different sectors. I'm highly diversified. I'm like, no, you're not. You have one asset class called stocks. Real diversification, have a slice of stocks, gold, real estate, cash. Agriculture is a good investment. Energy, forget the Green New Scam. That's a joke. Oil and natural gas are going to be around for a long time.
Populating these wealth generating places. I mean, just take any downtown area. It could be Melbourne or Adelaide or Sydney or New York for that matter. If there's an attractive downtown office building, let's say you're a large company, insurance company, whatever, and you used to have 10 floors as your corporate headquarters. Well, now everyone's been working from home for almost a year. That's nothing that anyone would have recommended, a year ago. But we were forced to do it, and guess what? It works. Employers and employees are finding that, hey, it works. You can communicate and get stuff done, and maybe there's some attractions to it. So this work from home thing is here to stay. Companies will do, they'll say, well, instead of 10 floors, I only need 2 floors, and I'll have attractive offices, but you'll reserve them. You'll call up and say, hey, I need an office 2 days next week to meet some clients. Done. They'll build locker rooms. They won't be like high school locker rooms. They'll be very attractive. You'll keep your laptop and your sweater and your scarf or whatever in your locker. You'll show up, take your stuff out of your locker. Some receptionist will tell you which office is yours for those 2 days. Set yourself up, meet your clients, go home and work from home. What does that mean? If you cut commercial real estate capacity or utilization by 80%, we'll start with the cleaning crew and the reception, but what about the food trucks, the restaurants, the shopping, the public transportation, drinks after work, on and on and on, all the things that are ancillary to that downtown office location. You cut that by 50 to 80%. What is that doing to your economy? So these are examples. By the way, this will take a year to play out. This is not an overnight thing. So the tenants are not paying rent. If they are, they've called up and negotiated a 50% increase. I have some involvement in commercial real estate, and I see this in real time. So rents are down by perhaps half or all the way to zero if they're not paying. And everyone says, well, landlords are rich. No, they're not. The landlords take the rents, but they have mortgages. So if the tenants aren't paying the landlords can't pay the mortgagee, and that falls on the banks, right? Except the banks are clever. They've securitized it and sold it probably to you and me, right? We have our 401ks like a superannuation fund, but you look in the fund and do you have some commercial real estate REIT or something that Morgan Stanley sold you? Well, maybe you do. And what's inside? No one knows, but take a look. But that ripple effect I just described can take a year to play out. So we haven't seen the end of this. So the bottom line on all this is that interest rates are going up in anticipation of inflation based on handouts. The reality is the handouts are not being spent, they're being saved, which does nothing for inflation. And it's also not sustainable, which is what are you going to do? Hand out a $2 trillion deficit spending package every 6 months? Because that's kind of what we've been doing since last summer. And they keep saying, well, this is the last one. It'll be sustainable. It's not sustainable. It's a handout and people need the money. But if they put it in the bank, which they're doing, this is a classic liquidity trap. So what's going to happen? Yeah. But meanwhile, the interest rates are going up, perhaps for the wrong reason, but they're going up. That's going to slow the economy further. We're already seeing mortgage applications dry up. We're seeing the housing bubble, not bubble, but pretty steep increase in residential housing starting to level up. So by, hard to say, but I would say by March or April, this whole thing is going to go in reverse. Everything we just talked about is going to go in reverse. The economy is not going to have the traction. Unemployment is going to remain high. Velocity is going to continue to drop. There's not going to be any inflation. Those interest rates are a headwind. They're going to drop, and the price of gold is going to shoot up. So my advice to potential gold investors is it's on sale. Go get some right now. It's always better to buy low and sell high. And but I would expect the price to be much higher by mid-year.
I know that you've said this before, or I'm pretty sure you've said this before, that to stimulate an economy, you need to reduce interest rates by somewhere around 3-4% to have an effect. When interest rates are currently at zero, how can you do that? Where do you go from zero?
Well, a couple of things. The short answer is you can't. You, in theory, you can go to negative rates, but negative rates don't work. We have experience from the ECB, Sweden, Japan, Switzerland, and elsewhere that negative rates don't work. They're negative rates, but they don't. It's not more of the same. Cutting rates from 3% to zero has a beneficial effect, but cutting them from 0 to -1. Now you're through the looking glass. You don't get any more pop. You don't get any more bang for the buck. And there are reasons for that, which are as a central bank, what signal are you sending? Well, see, the idea of negative rates is you're going to spend the money. Because if I'm going to take it away, you put money in the bank, even at 0, you put money in the bank, you go away for a year, come back, the same amount of money should be there. That's the 0 interest rate. But a negative interest rate, -1%, you put $100,000 in the bank, you go away for a year, you come back, you only have $99,000. Because I took $1,000, that's 1% negative interest. So the idea is, if I'm going to take your money, you're going to spend it fast because you don't want me to take your money. And that's going to have the stimulative effect that we talked about. That's not actually what happens. What happens, two things. Number one, people have lifetime goals. Their retirement, their healthcare, their parents' healthcare, their children's education, buying a house. There's some large lifetime goal you have, and that's why you save money in the first place. If I'm taking your money away, you're going to save more, not less. You still want to achieve that goal. I've made it more difficult, but you're actually going to save more. They want you to spend it, but now you're saving more. And the second thing is, what signal is a central bank sending when they have negative interest rates? They're saying that they're worried about deflation, not inflation, but deflation. Yeah. So if they're telling me, if central bank is telling me that deflation is a problem, I'm going to wait. And why should I buy anything right now? Wait till the price drops. And by the way, a negative interest rate, -1%, my example, is a nominal phenomena. But in real terms, if you have deflation, my money is worth more. So even though my dollar amount may be less, my purchasing power went up because prices went down. And so that's why negative interest rates don't work, because A, you're sending a deflation signal, so people defer spending, and B, they have lifetime goals, so they actually save more. So negative rates don't work. So you're right, you're stuck at 0, there you are. Pardon me, you can do QE, you can do quantitative easing. And usually what happens is they hand the ball over, it's a rugby match or whatever, but they hand the ball from monetary policy, which is now impotent, to fiscal policy, which is deficit spending. But there you have other kinds of headwinds having to do with very high debt levels. More to the point, in terms of what a central bank can actually do, they can't stimulate. They can print money, and governments can spend money and incur deficit spending. But again, none of it does any good if people don't actually spend it, and that's a psychological phenomenon. And the Fed or the Reserve Bank of Australia or any central bank can print money, no doubt about it, but they can't change people's psychology. We had an external shock, an exogenous shock in the form of the pandemic that caused people to stop spending, save more, or they were unemployed. Or if you're the unemployed individual, you're not taking your friends out for dinner these days. You're putting money in the bank, and even if you still have your job, you're going to save money because you're worried you might be next. You might be the next one to get laid off, or your company might shut down next week or next month. And so you're going to save more. It's what economists call precautionary savings, or, in plain English, saving for a rainy day. And that's what's going on. It's going on all over the world.
And last time I was in Hong Kong, I was giving a speech, very high level. The Asia Society was hosting it. And somebody took me aside and said, Jim, be careful what you say. The sequence is currency wars, trade wars, shooting wars. Shooting wars solve the problem. Mass mobilization warfare, destruction of capital, 50 million dead. very good for the labor market, very good for construction, very good for recovery. Not a great way to get there. Let's hope that doesn't happen. Let's talk a little bit about the trade war. A lot of people say, well, this started in January 2018 because Trump put tariffs on solar panels and appliances, your refrigerators or whatever. Well, yeah, you could say that, but I would say the trade war started in 1994 when China did a maxi devaluation of the yuan, continued through 2001 when they made a bunch of promises to join the WTO, World Trade Organization, and broke every single promise, continued through the early 2000s when they were manipulating the currency, and continued through 2016 where they were admitted to the IMF special drawing right basket of currencies, one of only 5, and lied to the IMF because they said we'd have an open capital account, and they shut the capital account the following year. So what he did in 2018, I view as the U.S. finally got the wake-up call and retaliated. Here's the globalist mantra, and this goes back to the 1990s, and whether it's Richard Haas, Jeffrey Sachs, President Clinton, President Bush, many others, it's a long list of people. They said, look, we understand that Chinese are communists and they're kind of bad actors and they do bad things, but if they're willing to embrace something that looks a little bit like capitalism, they will grow richer. They will grow more sophisticated. The education level will go up. We will accommodate that by letting them join the World Trade Organization and the IMF, even though we know they lie, cheat, steal, because they will eventually get rich enough that they will be just like us. They'll throw off their communist masters, embrace a Western model, and it'll be just like Europe. We're all on the same team, democratic, quasi-socialist, but democratic, capitalist, liberal, in quotation marks, societies, and China will be just like us. That was the theory. I said it was wrong at the time, and time has proved that correct, meaning they're just rich communists. I said the only thing worse than a poor communist is a rich communist. And so we have created rich communists at the expense of our own workers, at the expense of our own economies. They are not like us. They're more communists than ever. Communists, atheists. The human rights violations are incalculable. If you're a Uyghur, maybe a Muslim Uyghur, or a Catholic in China, and you express any dissent at all, you will be arrested. You'll be put in a concentration camp, indoctrinated with communist philosophy. Maybe you'll get it, maybe you'll fake it, maybe you won't. But for those who apparently don't get it, they're strapped to an operating table without anesthetic, and their organs are removed while they're still alive and sold to the organ tourism industry, this huge multi-billion-dollar transplant industry in China, and then they cremate the bodies. That's real. And what does that sound like? Killing innocent people and cremating the bodies? Have we seen that movie before? So that's who I don't know why we do business with China at all. So that's who you're dealing with. They're not getting more like us. They've elevated Xi to, first of all, president for life. There used to be this, you got two 5-year terms, and then in your second term, you kind of announced or anointed your successor, who would then pick up the reins at the end of your second 5-year term. That process was, which is driven by consensus, was working very well and giving China a little bit of stability. Xi tore it up. He's in his second 5-year term now, but he did not announce a successor. And at the last National Party Congress, they changed the rules so that he can stay on indefinitely. So he's president for life. They also created something called Xi Thought, which is a big deal because it elevates his ideological musings to the level of Mao thought. He's only the second Chinese leader to get that designation. All the others, okay, you're president of China, head of the Communist Party, whatever, but they were never treated on a par with Mao. Xi is. So we have Xi Thought. We have, gross human rights violations, geopolitical confrontation, near war in the South China Sea, testing the boundaries with India, all the, intellectual property theft, lie, cheat, steal through the economy. Their numbers are fake, by the way. I'm sure you've heard of something called Goodhart's Law. Goodhart's Law says, when a metric becomes the object of policy, it loses meaning as a metric. So in other words, if you compute your GDP honestly, it's valuable information. It tells you what your economy is doing. But the minute you target GDP as a matter of policy, it loses meaning because you're just manipulating to a result. That's what they're doing. And this is a big deal because U.S. companies are watching this now. Apple's although Chinese value added in the iPhone is about 6 or 7%. 100% of the cost of an iPhone is treated as a Chinese export and a U.S. import. but their value added is only about 7%, give or take, because they buy the Gorilla Glass they buy from Germany, the circuits they buy from Japan, they buy other components from South Korea, so they have to pay as much as they get, and then they're just assemblers. These are Lego-style assembly jobs, and don't underestimate the extent of the poor working conditions, slave labor, prisoner labor, some of the things that go into this.
Okay.
But American companies are getting the wake-up call, they're getting the message, and what they're doing, this is a very big deal, they're moving the supply chain origin to Vietnam, Thailand, Indonesia, and these are 10-year decisions. You don't move your factory from China to Vietnam and then move it back next year if things are good. You keep it there. Again, these are major fixed assets, major long-term investments. So if you move it out, you're not coming back, maybe ever. And so these are permanent losses of jobs to China. And their GDP is overstated, grossly overstated. My adjustment gets them down from round numbers from about 6.2% to maybe a little under 4, 3.8 or so. But I've seen other scholars whose opinion I respect say it's more like 2.5%, and some say 0. Okay. So China is the growth slowdown is abrupt. It's material. And it's getting worse. And so what will happen is Xi's status is now at risk. I mean, okay, he may be president for life and Xi thought and all that. He may be the most powerful leader since Mao. But, the Cultural Revolution got a little bit out of control for Mao too. And so the Politburo, they're going to be careful, but they may get rid of Xi at some point. Or you may see social unrest. You may see Hong Kong writ large. And Hong Kong's not going away. That situation's not getting better. Well, first of all, China will invade. They kind of already have. They haven't sent in the People's Liberation Army, but they have an armed paramilitary police force. They're already in there, and they'll do more. The violence will get worse. The social unrest will get worse. I've been gone to Hong Kong for 35 years or more. It's interesting. If you had asked me in the early '80s, and when I first started going to Hong Kong, just describe Hong Kong, I would have said, well, it's the second most vibrant city in the world after New York. New York would always be number one, but nightlife, energy, finance, attitude, everything about Hong Kong was just amazing. Every time I went back there, and I was there last year, it got worse. It got more subdued. People got more depressed, and then in the 2000s, I could really detect the funk. It's like, we're here, we're working, we're a financial center, but this is no fun, and we're kind of looking over our backs. And last time I was in Hong Kong, I was giving a speech, very high level. The Asia Society was hosting it. And somebody took me aside and said, Jim, be careful what you say. And I had never heard that before, not in Hong Kong. I mean, someone might have said that in Beijing or Moscow or someplace, but not in Hong Kong. So, and I said what I wanted anyway. I was getting out the next day, but it's bad. Well, it's obviously bad because there are violent demonstrations, and a few people have died, and more may die. But that's going to get worse. That genie's out of the bottle.
Okay.
But the Fed has a hidden asset.
What is the hidden asset? And how do you make millions from it? According to Jim Rickards, the Fed has a hidden asset called gold certificate. It's something that the Fed can and will use in times of emergency when we return to the gold standard. How and when the Fed will use it? Well, they'll use it to back the dollar when the dollar collapses and people no longer trust it. The Fed needs thousands of tons of gold, so they'll buy it from the public. So, what is exactly this gold certificate? Let's hear more from Jim Rickards.
If you go to the balance sheet, go to the asset side, the first line item, there's something called gold certificate. And what is that? Well, in 1934, the U.S. Treasury confiscated the Fed's gold. They had already taken the gold from the U.S. citizens by that point, but they wanted it all. And so they took the Fed's gold, but under the but again, bear in mind, the Fed's privately owned. So under the Fifth Amendment of the U.S. Constitution, it is illegal, it's unconstitutional to seize property without paying just compensation. You can do it, but you got to pay the person, and then people get into all kinds of arguments about what it's actually worth. So what just compensation did the Treasury give to the Fed when they took the Fed's gold in 1934? The answer is they gave them a gold certificate. It can be, you can calculate it. In other words, you can say, well, what is the amount of gold by weight, not by dollar value, but by weight that is needed to back up that certificate given the historic cost? Well, the answer is about 8,000 tons. Guess how much gold the Treasury has? About 8,000 tons. I mean, one of the reasons I've hypothesized that the Treasury stopped selling gold in 1980 because they lost gold to trading partners between 1950 and 1970. They lost 11,000 tons. Down, they went from 20 to 9, but they sold another 1,000 tons in the 1970s to suppress the price of gold, which failed because it always does. But by 1980, they had were down to 8,000 tons and they stopped. Why did the U.S. stop selling gold? We've never sold any significant amount of gold since. The answer is, in my view, is that they can't go below that because that's the amount of gold the Treasury needs to back up this gold certificate on the Fed's books. So, okay, just kind of put that into one side. That asset is valued on the Fed's balance sheet at $42.22 an ounce. The price of gold, look today, it was about $1,850 an ounce. Now, so, what's, as I say, sauce for the goose is sauce for the gander. If we're going to mark the mortgages to market in a world where interest rates have gone up and the mortgages have gone down, it's only fair to mark the gold to market. And if you mark that gold to market at $1,850 an ounce versus $42, voila, you would find that the Fed has another approximately $350 billion of hidden assets. So that takes care, I think that takes care of the solvency problem. So before we beat up the Fed on mark to market on mortgages, that's fine. But have a look at the gold and realize that they have a hidden asset, a shadow asset on their books that's worth in the hundreds of billions of dollars.
We've heard from Jim that the Fed has hundreds of billions of dollars of a hidden asset, and that hidden asset is a gold certificate held by the Fed and backed up by real gold in the U.S. Treasury. When the time comes, the Fed will definitely use it to back the new dollar. They'll even buy more gold from the public, and therefore the price will go up significantly. But how much exactly is the price of gold will go up? Is it a big deal?
I think it would be a very big deal. But it begs the question, if you're going to revalue it, to what level do you revalue it? So everyone said, well, the market's 1850, that's about where it is today. It goes up and down, but revalue it at 1850. That could be highly deflationary. And the reason is, in effect, you're putting yourself on a gold standard. You don't have to. That's why they won't do it. They don't want to touch it. But if you did, you would be saying, hey, gold's really worth 1850 and we have this much gold, et cetera. But at that point, analysts would sort of turn and say, well, okay, well, you're back to a kind of gold standard. What's the relationship between gold and money or currency or US dollars and others, the money supply? But what is the relationship between gold and money supply? What you would find is that at 1850, the gold relative to the money supply is about 2%. Whereas historic gold standards were run with somewhere between 20 and 40%. Bank of England in the 19th century managed a successful gold standard between the Congress of Vienna and World War I with about 20% gold. In the US, through most of the 20th century, at least the first half, ran a gold standard with about 40% backing. It was actually the law. The law until the late 1960s, I think 1968, was that the Fed money supply, base money, could not be more than 2.5 times the value of gold. Originally at $20 an ounce, $20.67 an ounce, later $35 an ounce. But whatever that number was, times the amount of gold, that had to be 40% of the money supply, and the money supply could not be greater than that. And then they got rid of that in 1968 because of the war in Vietnam. But the point being, 20% has worked, 40% definitely works. The Austrians like to bang the table and insist on 100%, but maybe, but that's historically not been required. You just need enough gold to be able to give gold to people who want it when they want it. And if you're credible in that dimension, most people are content to hold the money. So as a hypothetical, you can say, well, okay, let's say we want a gold standard, and let's say that we want 40% backing of M1. M2 is a bigger number, or at least it can be. Let's just say, so 40% backing of M1, that's a conservative kind of gold standard, not extreme, but reasonable.
From February to March 2020, the Fed has printed $2 trillion. The impact of that is our money supply goes up and so does our inflation. With massive price increases in food and energy, gold prices would have to rise too, right? And if the Fed uses 40% gold backing to back the new dollar, and with the current high inflation that we have, what would the price of gold be? Jim Rickards gives a staggering gold price prediction. Let's listen to Jim.
What would given the amount of gold the United States has, what would the price of gold have to be in order to maintain that ratio? The answer is about $15,000 an ounce. And people say, oh, Jim, you used to say $10,000 an ounce. Well, that's true because it was true at the time. But when you expand the money supply, the number goes up, right? Because the amount of gold is fixed. So yeah, it was 10,000 not that many years ago, and today it's 15,000. Well, if you say gold's worth 1,800, people are going to say, well, give me the gold. I'll take all the gold you got at that price. And then they're going to have to shut the gold window again, and that has its own problems. But in other words, it's not clear how it would work. I mean, there are a lot of ways it could work mechanically. It's not clear what the government would actually do. But my point is, if you try to mark gold to market on the Fed's balance sheet, you're opening Pandora's box. Because you would be getting a lot of people, bankers, analysts, Wall Streeters, investors, to sit up and take notice and say, well, hey, what is going on here? You're back in the gold business. Well, you got the price wrong because you can't back up your money supply at that level. And the truth is you can't. But a global recession is highly unusual, and that appears to be what we're heading for. So my forecast, I do update them, but big picture, it goes as follows. So what is Jay Powell doing? First of all, March 1st, 2022, the Fed fund policy rate, interest rates were 0. And we're now at 4.5%. Even in the Volcker days, we never went up 4.5% in 10 months. Not that fast. And so here we are. So what is Powell doing? Well, he's given 5 speeches on the subject. I don't know why Wall Street doesn't listen, but he keeps trying. He said the same thing every time. He said, inflation is job one. We're just going after inflation. Believe us. There is going to be a recession. Unemployment is going to go up. There's going to be pain. I've never heard a Fed chairman use the word pain. He used it 5 times in one paragraph in the Jackson Hole speech. And that's what we're doing. And believe us when we say it.
According to Jim Rickards, a global recession is coming and it's going to be painful. Unemployment will go up, the economy is slowing down, and the Federal Reserve has already used every single tool that they have. Inflation has come down, but for a really bad reason. We will get into the reason later in the video. There's the myth of something called the terminal rate. Simply put, it's a rate that the Federal Reserve needs to reach so that inflation will come down on its own without further rate hikes. Wall Street said the Fed is already at the terminal rate so they don't need to raise it anymore, but the Fed is saying, no, we haven't reached the terminal rate yet, so we have to keep raising it until we reach the 2% inflation target. So the question is, how long will the Fed keep raising the interest rates? We're already over 5% now and the Fed's still planning to raise it even more? With the current high interest rate, these tech companies already laying off a lot of their employees because they have to tighten their finances. What if the Fed raises it even more? Let's find out.
Now, how long will he raise rates? How quickly? And what's he trying to do? Powell is trying to get to something that he calls the terminal rate. But the definition of the terminal rate is it's a rate that's high enough to cause inflation to come down on its own without further hikes. So we'll get to a level, and then inflation is coming down, by the way. And in the last 5 months, in the U.S., it's gone from about 9% to 8.7, 8.2, 7.4, 7.1. So it is coming down. Having said that, the target is 2%, and 7.1 is still a far cry from 2. So he's not there, but he's making progress. So here's I hate to use the word conundrum, but it kind of is. Wall Street's saying, you're done. You did it. Mission accomplished. Inflation is coming down. You got what you wanted. Give it time. Stop raising rates. You're going to kill the economy. But the Fed is saying, well, we actually don't know. We can't untangle it. Yes, inflation is coming down. That's objective. But is it coming down because we're still raising rates? Or is it coming down because we're at the terminal rate? Those are two different things. Right now, and this is what Powell's been saying, the Fed leans to the view that they're not at the terminal rate, that inflation is coming down because they're raising rates. They have not achieved the terminal rate. So Powell and the Fed have said, yeah, inflation's coming down, but it's because we're raising rates, not because we're at the terminal rate. We're going to get to the terminal rate, probably 2 more hikes, and then we'll pause. And then if we're right, we'll just let inflation come down on its own. And that may take a year. So all this stuff about the Fed pivot and cutting rates and all that stuff, I mean, the Fed's thinking mid 2024 before they do that. Now, Wall Street are saying, no, you're not going to get that far. You may be at the terminal rate already. You're definitely going to cause a recession. It'll be more severe than you think. And rates are going to have to come down sooner than people expect. In other words, you've already achieved the terminal rate. You just don't know it. And you'll probably be the last to know. So with Wall Street, with the cheerleaders, sending that message, but with some serious market indicators, including yield curves, sending that message, why is Powell sticking to the game plan as I described it? And the answer goes back to 1980, believe it or not, and what's called the Volcker mistake.
Jim Rickards said something about the Volcker mistake and why Jerome Powell is still raising the interest rate and not cutting it yet. The famous Fed pivot, as Wall Street calls it. Jay Powell doesn't want to repeat the Volcker mistake by cutting the interest rates too early and failing to bring inflation down. Do you know why the interest rate was raised to 20% back in the 1980s? It's because of the Volcker mistake. The tale goes as follows. In the late 1970s, inflation was going up a lot and therefore the interest rates rose from around 4.5% to 10%. But that 5% raise took 3 years, from 1976 to 1979. Meanwhile, the current rate hike that we have now is the fastest in history. We went from 0 to 5.25% in just 1 year. Back in the 80s, we had a recession, and the chairman of the Fed, Paul Volcker, had to cut the interest rate down by 7%. Not 0.7%, but 7 full percentage points. He cut the interest rate from 17% to around 10%. And after that pivot, he raised it back to 20%, and 3 years later in 1987 the rates finally came back to normal. Back then, we needed 10 years in order to finally win the inflation fight. And now what? We're expecting it to win in a couple of months? The Fed just raised the rates fastest in history and people expect to bring it back down? Let's get into the detail.
People forget that there was a recession in 1980. It was sharp but quick. It was over very quickly. It had nothing to do with monetary policy. The Carter administration issued some dopey regulation on a ceiling on credit card interest rates. And the industry said, fine, we're just not going to lend anybody any money. The economy fell instantly, kind of like a smaller version of what happened in 2020 with the pandemic panic. And then they said, oh, sorry, just kidding. And then they took the ceiling off and then things got back to normal. Now, this was a time when farmers around the country were driving front loaders and tractors to Washington, and they were circling the Fed building. And one guy drove his tractor up the steps of the Fed, and Volcker was being burned in effigy. That all happened. So it was a little bit of pressure. And of course, Congress was up in arms and the White House was up in arms. So Volcker, not quite panicked, but he cut interest rates 7 percentage points, not 0.7, 7 full percentage points to deal with the recession, which, number one, was unnecessary because the recession was caused by a policy blunder from the White House, which was quickly corrected. And number two, he had not won the fight against inflation. Well, after he cut rates and we came out of that very quick sort of snap recession, inflation got even worse. And that's when Volcker had to raise rates to 20%. And Volcker, in hindsight, and he said this in his last book, just before he died, he said, we shouldn't have done that. We should have stuck to our inflation mission. So now Powell, remember, Powell's not an economist. He's a lawyer. So he kind of thinks like a lawyer. I can relate to that, looking at both sides. Powell does not want to be that guy. He does not want to be the guy who balks early and cuts rates, the famous Wall Street pivot, before the battle against inflation is won, because the outcome could be exactly what Volcker experienced, which is inflation wasn't done, doesn't go away, comes back stronger, and then you do have to destroy the economy, as we did in 1981-82. That was the worst recession. That was far worse than the little one in 1980. That was the worst since the Great Depression. We've managed to break that record several times since then, but at the time that was horrific. But Volcker and others have said that was a blunder he never should have done. So Powell does not want to give up the rate hikes too early because he does not want to repeat the Volcker mistake. He does not want to be that guy. And that's what's driving him, even as Wall Street screams, you're already there. So the question, so that's the lay of the land. There's the two competing sides. How does this play out?
We learned a lot from Jim about the current situation and what Jerome Powell will be doing. But there's more to that story. Powell doesn't even understand what's going on in the real world, which is inflation itself. There are two sources of inflation, the supply side and the demand side. We are at the supply side inflation, which means the supply of goods is scarce but the demand is high and therefore the prices go up. But supply side inflation can transform into demand side inflation, and this is where the dangers begin. People's spending behavior changes and they're worried that something worse will happen, and then they grab everything they can, and therefore the demand rises, and you got yourself inflation caused by an increase in the demand side. That's what most people don't understand, including Wall Street. Wall Street said inflation will come down on its own because we've reached the terminal rate. But Jerome Powell thinks we are not done yet and therefore he will raise rates even more. And what does Jim Rickards think? Does he think Powell is at the terminal rate yet?
In my view, Powell probably is there. He probably is at something like a terminal rate. He probably doesn't have to raise interest rates anymore. He doesn't believe that himself. His models tell him otherwise because they're relying on the Phillips curve, which is junk science. I mean, the last time I looked at a Phillips curve, it was flat. At least where I went to school, curve was curved. This thing is flat. There is no correlation between unemployment and inflation. There just isn't. But the Fed thinks there is. So I always tell people, don't. If you want to forecast Fed policy and understand the Fed, don't think like a rational person. You have to think like the Fed. You have to get inside their heads or else you're going to get it wrong. So they're looking at unemployment, which is the lowest. The unemployment rate is the lowest since 1969. Well, if you believe in the Phillips curve, then that's a sure sign of inflation. As I say, even though it's coming down, it's still pretty high. So they think they have to keep fighting this fight. But here's what they're missing. Here's where it all falls down. Yeah, inflation as measured, CPI, PPI, personal consumption expenditure, core, non-core, year over year. There are like 20 different ways to measure it. It is coming down, but there are two sources of inflation, and it's going to sound obvious, but you got to separate them: the supply side and the demand side. They both result in price increases, but they have completely different dynamics. Supply side inflation is what we're seeing. It's what we saw in 1974 with the Arab oil embargo during the Arab-Israeli war when they cut us off from oil. And, you had to line up for gasoline. I lived through that. Bare shelves, and you couldn't get certain things. It wasn't that every supermarket shelf was bare the way it was in East Germany in the 1950s, but something was always missing. And that's still the case today. So, of course, prices went up and, people were trying to pay whatever they had to get what they needed. And energy prices were a big driver of that. So that feeds through as a form of inflation. The other kind of inflation is from the demand side. So the supply side is called a cost push. Costs go up and they push it onto the consumers. The other kind is from the demand side. It's called demand pull. And basically consumers have a change in mentality. They're worried about inflation. They would say, hey, I was thinking about buying a refrigerator. Gee, I better go buy it today because if I wait for 6 months, the price is going to go up. Or apply that to anything, a new dress, new suit of clothes, whatever. And so you're pulling demand forward and it's behavioral. And that will also drive prices up. But they're very different things. Now, cost push can morph into demand pull. That's what happened in the 70s. It started from the supply side. But by the late 70s, 80s, and Volcker, which we've just been talking about, it had tipped over into the demand side. That hasn't happened yet. We've had the supply side inflation, the cost push. It hasn't yet tipped into demand pull. It hasn't really affected consumer behavior that much in terms of people anticipating more inflation. It could, but it hasn't happened yet. Here's why that's an important distinction. Cost push inflation negates itself. The old saying that the cure for high oil prices is high oil prices because people can't afford it. Maybe if demand is inelastic, if you got to fill up your Ford F-150 truck with gasoline to take the kids to school or go to work. But if you're unemployed, you're not buying any gas because you're not leaving the house. So it tends to negate itself, whereas demand pull feeds on itself. Powell has not made that distinction. And if I'm right, and I think I am right, and the evidence backs that up, this inflation will come down, not because the Fed is raising interest rates, but because higher prices destroy demand all on their own. If I used to pay $75 to fill up my truck with gas, and now I have to pay $150, which is about right, I'll do it because I got to get to work. But that's $75 I'm not going to spend on something else. I'm not going to go out for dinner. I'm not going to go to a show, a concert, or buy a new camera, whatever it might be. So it does tend to depress demand, destroy demand, and hurt the economy. And then it slows down, and then the inflation comes down on its own. That appears to be happening. But Powell hasn't really made the distinction. He's fighting the last war. I hate to use a cliche, but he's fighting the Volcker War. And what he's got looks a little bit more like the Herbert Hoover War. That looks a little bit more like the 1930s than the 1970s. So the bottom line on all this is the Fed is going to raise rates at least twice more for the reasons I mentioned. Powell doesn't want to repeat the Volcker mistake. He thinks the battle's not won. He has to get to the terminal rate. In reality, he's probably already there, if there is such a thing as a terminal rate. It's another one of these things they made up. Inflation is coming down, and so will probably continue, but for really bad reasons.